everyone. Welcome from Allraise. And as you are trickling in, please feel free to introduce yourselves in the chat, just for everyone else to see who's in the room, and also for some of our speakers today, just to see who is on the other side of the line. We always love to see all of that. And I'm Marian Arake. I'm from Allraise, and super excited today to be working with Level Ventures and Ian in putting on this event for all of you. And very quickly, as some of you already know, Allraise is a nonprofit dedicated to amplifying female voices, accelerating female success, and creating a tech culture where women are leading, shaping, and funding the future. Our events and our volunteers who make them possible are key to building and amplifying the movement that will rewire the tech and venture capital industry, creating more power for women and our allies. So we're really excited to have you all join us today. And before we get started, I just want to point out two functions of the webinar today. There's the chat function. So again, please feel free to introduce yourselves. Let us know where you are, your name, your fund, and or company. So definitely use that. And we also have a Q&A box. So as your questions come up, please feel free to put your questions in the Q&A box. It's going to really help us keep a tab on all the questions coming in. So please use that. And this event will be recorded and will be published on our website within 48 hours. So keep an eye out on that. And without further ado, I'm going to hand it over to Ian.
Hi there, everyone. Great to have everyone here, and we've got a fantastic lineup of panelists. First off, a big thank you to Allraise for working to make this happen, and then also we have other sponsorship from First Republic Bank. So thanks to those guys for being involved in making this happen. So what I thought we could do first off is set out the agenda. So we're going to have really three parts. The first part is going to be, and you'll see it come up after we do the introductions, is a poll. And the poll will go out to everyone, and the poll has some questions. I would love for you guys to answer those questions. As the poll is going on, we'll then have three questions which we'll ask the panelists. And those three questions will try and tease out what are some of the challenges those who went about raising their second fund and those about to start that journey. And then the third part is then the feedback. We'll get the poll back. We'll then look at the poll results and talk about the poll and also open up for Q&A. So three parts. But the kickoff first, we're going to have an introduction to the team, and then we'll have a great overview from First Republic on just to set the scene, like what's happening right now in the marketplace. And First Republic is really well positioned to do that analysis since they have a complete overview of the landscape. So starting off, let's do the introductions. Let's do Bridget, Keisha, SC, Hannah, and then Caroline, and then myself. All right.
Great. Hi, everyone. Bridget Schweihs with 50 South Capital. We are a $10 billion alternatives platform based here in Chicago. And within the alternative space, we have a private equity team that covers buyout, growth, venture, and it's a global portfolio, and I spend my time exclusively on venture.
Hi, everyone. My name is Keisha Cash. I'm the founder and general partner of Impact America Fund. We're a small and proud impact investment fund. We manage $65 million across two funds and focus on the intersection of technology, where technology meets community. So we're investing post-seed, pre-series A in bridge rounds. And then we have follow-on capital for future rounds. But our sweet spot is that intersection of tech plus community. But we're rigorous, obviously, like a traditional venture firm. So looking forward to meeting you all and talking to you all today.
Hi, everyone. SC Moatti. I'm the founder and managing partner of Moatti Capital. We're a venture fund that invests in Series A Bay Area-based companies for the most part. In our portfolio, we have Airbnb, Amplitude, DigitalOcean, to name a few. What sets us apart is that when we invest, we give our portfolio companies access to over 300,000 product managers, and our portfolio use them and access them and turn them into customers. So we really help them boost their revenue.
I think it's my turn.
Yep.
Thanks, Ian. Hi, my name is Hannah Yang, and I am with First Republic Bank's Venture Capital team. I'm a managing director and part of the Emerging Managers program. And I'm also involved in leading our Women in Venture Capital initiatives here. So excited to be here, and thank you to Ian and the All Raise team to inviting me.
Hi everyone, I'm Caroline Hale. I'm also with First Republic Bank on the venture capital banking team focused on emerging managers. And I cover platform and community amongst a lot of other things, but excited to be here with all of you today. Thanks.
And dropping out myself, Level Ventures, we help emerging managers basically start their own fund. We work a lot in helping minorities get into the venture industry. And we have a group of family offices who we introduce emerging managers to give them a chance to build their own fund. So in terms of, as a starting off point, I first of all like to thank SC for the fireplace she has to give a sense of atmosphere to the experience. So thank you for that, SC. And now when we have First Republic go first and share the insights you guys have gathered from the market.
Sure.
And then Ian, please let me know when you want me to.
Can everyone see the screen? Yes.
Yes.
Okay. All right, great. So I saw some names and fun names here on the chat. So many of them we know or we follow. So as many of you know, FRB has had a long history of specializing in venture capital, particularly in emerging managers. We bank over 500 VC firms today, of which 350 plus are emerging managers. We continue to be super excited about this category of emerging managers and believe that they will be, you all will be the next generation platform funds for venture capital. So to kick things off, as you said, we wanted to give everyone a sense of the market. Here's a quick breakdown. So there were over 200 emerging manager funds in 2020, of which 70 of them were Fund 2s. I believe today's webinar is around Fund 2, so we'll focus on them. But then the average fund size was 125 million. However, the median was 50. Next slide. Oh, Karen. Next slide. Yeah. Here's a quick breakdown of partnership type. Lately, we've been hearing a lot more LPs talk about liking the solo GP model. And this is totally anecdotal, of course, but we also think that this may go back to original thought around solo GP risk once things go back to normal. As far as fundraising duration goes, on average, managers spent roughly around 19 months raising between 2018 and early 2020. And we're looking to do a refresh of kind of the pandemic impact on the duration of fundraising. So we need to refresh and report that back to you. Next slide. As we know, non-institutional sources of capital, such as family offices or ultra high net worth individuals, have been critical for emerging managers and continue to play an important role. This slide shows that 33% of commitments in Fund 1s were from institutional LPs versus non-institutional. And this scales up to 50% by Fund 3. And Fund 3 is typically when emerging managers start to demonstrate more traction and performance. So that's also making sense. Lastly, we put together, so next slide, Caroline. Lastly, we put together a slide of some actionable tips for you as you're planning to raise Fund 2. Number one, not always, but Fund 1 LP composition can dictate what Fund 2 LP composition will look like. Fund 2s can also take as long as Fund 1 to raise, as some may or may not be experiencing that right now, but especially if you want to add institutional LPs. We're also saying that fundraising is no longer episodic. So think about building your IR infrastructure, your fundraising infrastructure processes as soon as possible, since your LP base will likely increase in Fund 2, and it might be tougher to manage all those relationships. Number 4 would be make sure to have high quality institutional level client servicing for your LP relationship management. One that we hear a lot as well and continues to be top 3 in terms of in the LP surveys that we send out is don't drift from strategy. You know, changing strategy or scope creep, that has been a top pet peeve for LPs. Number 6, don't oversize the fund or don't set unrealistic expectations of fund size. And if you do end up sizing up the fund in a way, be ready to answer those questions. Are you going to add more partners? What about the strategy is changing and why? But typically we've heard and we've seen oversizing the fund has been kind of tougher, and managers kind of have to reevaluate the fund size as they go into Fund 2. Lastly, but not least, it's critical to continue to develop market presence as you go from Fund 1 to Fund 2. And, LPs care a lot about this, right? The thought leadership, like the branding. So that's another area that I would say kind of goes hand in hand with fundraising. Next slide. So here's this team. I know we went super quickly just now with the slides, but I do want to make sure that everyone has time to listen to from the experts, the managers themselves. But do reach out to any one of us. Here's the team. And if you have any questions or need any help, we're here to help you. Thank you.
Well, very good. That's a good tease up some questions as well for later on from the audience. And I thought maybe at this point, let's send out the poll. And so folks, when this gets to you, if you wouldn't mind answering it. And then as this is going on, we're going to start off with our first question. So let's ask, this is the first question. So if you were a fund manager, what advice would you be giving to them as they're going out the next, say, 12 months to raise their second fund? And maybe we start with SC, because I think you've just recently done this. You've just gone through this action yourself. So maybe you could share some insights, what you learned the last time you went out.
Yes, definitely. So we just finished raising Fund 2. Fund 1 and Fund 2 were both oversubscribed. Fund 2 was raised during COVID, which led to some really interesting learnings. The biggest differences from Fund 1 to Fund 2, to be honest, so what stayed the same is in Fund 2, you're still selling your story. So you're still, raising on the promise of returns, and you may or may not have a track record from, kind of personal investments, but it's unlikely that you have a lot of returns from your Fund 1 to prove your Fund 2 story. So relationships are actually really, really important, and especially LP relationships, right? So people who continue to follow your story and continue on with you from Fund 1 to Fund 2. So that's been, a really big source of funding for us. Our Fund 1 LPs investing in Fund 2 and referring other people and other institutions to invest in Fund 2. The second thing that's been really big for us in Fund 2 in terms of fundraising is really our ability to demonstrate that our model works, right? So our differentiation with case studies of entrepreneurs in our portfolio who have been able to get value from our 300,000 product managers. So it's like basically showing that we're telling a story to entrepreneurs that hopefully will yield to better returns, right? So telling that story. And then another, I will say, massive or big factor in our ability to fundraise is also our personal commitment. Fund 1 and Fund 2, us as GP, we made a significant personal commitment to each of the funds, and it's a big factor because people see that while we're still a small fund, and so our upside is very much the carry, we continue to invest, and it shows. I mean, we have a lot of skin in the game, basically.
And then how long did it take? And we just saw that First Republic saying it took an average of 19 months. How long did your, during this COVID, the pandemic, all that going on at the same time, how long did it take you to raise the second fund?
Yeah, so longer than the first fund because COVID really put a damper in things. Our first fund we raised in about 6 months or less, and was more than 30% oversubscribed. Our second fund, we basically did a close March 31st, And then everything went sort of silent for a few months. And then in the fall, things started to pick up again. So there was a kind of a 6 months period where, you know, as you can imagine, for most people, people were still interested to follow. They could see that possibly, you know, times of great turmoil are times of great opportunity. But in terms of commitment, not being able to meet in person and so on and so forth. So we added, you know, probably 9 months to our fundraise just because of COVID. In terms of, you know, if you're going to market right now, I would say like what we're seeing was the very last conversation we've had this year is exactly the same thing. People basically saying, this is really interesting, but we would love to meet in person once again. And so raising now, I think is a big challenge, as opposed to if you can postpone your raise by, you know, say 9 months, like started in Q4 this year, when it's going to be a lot more possible to have in-person meetings.
Now, Bridget, you represent the LP side of the equation. It's always interesting to get the other perspective. Now, what advice would you be giving someone? Would you say, hey, don't bother raising, come back in Q4? Or do you say, no matter what, if you've got a great thesis, we want that meeting and we'll have to chat? So where are you from the LP's perspective?
Yeah, I mean, I think a lot of LPs tend to have allocations by calendar year. So earlier in the year, the better. But obviously everyone's sick of hearing unprecedented times, but there's no rule book for raising capital during a pandemic. So but I do agree that as much as you can kind of wait till things are back to normal, and you can meet in person, because it is such a relationship focused business, being able to meet in person and develop a rapport and get to know each other and build trust is very important. So, you know, as much as being earlier in the calendar year can be an advantage, you know, possibly waiting a little bit and hopefully meeting in person with LPs.
So when was the last time you met in person with someone?
Early March.
Okay.
Yeah. So not to say we have committed to, you know, we've re-upped with existing managers and we have committed to people that we had relationships before. But to start a new relationship with an institutional LP takes time under normal circumstances. You know, a lot of times it's helpful to build a you know, a relationship when you're raising fund one and say, I know that, you know, maybe you don't have an emerging manager you know, strategy, but to build that relationship, send the quarterly newsletters, make sure that the potential LPs for fund two are aware of what you're building with fund one. Right.
That's interesting. And now maybe a second question is a follow on from that, and is like, so what was, I suppose, this is maybe for you, Keisha, what was, I suppose, you think of unexpectedly difficult about raising your fund? Or what was the surprise to you? I mean, obviously you raised your first fund successfully, but what was different about the second fund?
Yeah, no, great question. And I'm glad to see, applause to the impact investors that are in the house. I see a number of folks in the chat that have said that you're focused on impact and sustainability. When we raised fund one, you know, we did that in 2016, we closed fund one, and our thesis today was our thesis then, in that we have major systemic issues in America that need to be addressed, and we believe that technology can be used as a tool to scale solutions as well as create obviously financial returns to investors. And we talked about systemic inherent issues like racism in America, and we were talking about that in 2014, and even prior to that, to raise a fund one to test to see whether or not we could apply venture capital in a way that was rigorous, could create financial returns as well as address some of these systemic issues. So, you know, fast forward, we started raising fund two in 2018 on the same thesis, but with a finer point based on the lessons learned from fund one. We were broad in fund one and looking across health, education, income, the indicators of health and well-being in this country, particularly for low-income communities. And then our finer point for fund two was really looking at economic opportunity, fintech, but with the lens on financial inclusion for low and moderate income communities. So we had this different twist on themes that were, you could look across the traditional venture landscape and see that there was activity and interest, but we wanted to make sure that that was inclusive of low and moderate income people, as well as people of color. So that's the story that we were telling and selling in 2014 and 2016 before the country was woke up by the affairs of last year. And that was challenging. So thankfully our early LPs were, you know, the more progressive family offices and foundations that are out there, and were supporters in Fund 1 to what SC said, and they were following us with Fund 2, but we were raising much more than our first $10 million fund. And we started having these conversations with institutional partners that moved the needle, Cambridge Associates and others that were seeing client demand. So we were a bit before our time in the sense of it being an institutional call to action for institutions to move capital in a more meaningful, impactful way in the asset class of venture capital. And so that made it much more challenging than not to raise Fund 2. And then we reached this point, you know, unfortunately, but a tailwind for us is when America exploded last year with the killing of George Floyd. And then there was this, you know, undesirable tailwind, so to speak, that created more momentum than we had initially. And we actually closed the fund early. We had a lot of institutions that, you know, are still emailing us about getting in our Fund 2, but we wanted to do the work. So, you know, I think based on a long-winded way of saying, based on your thesis, and many of you are focused on sustainability and thinking about, you know, how do you create innovations that change the world for the better? Sometimes it's a hard sell, and it may require a bit more time to get the right players kind of sold on that. Right now is a moment in time. So while I do think it's difficult to raise in this environment because of COVID, I know a lot of people are paying attention to sustainability and social and economic issues. So if you have a strong thesis, you know, I'd say to continue to push on that.
So then your thesis really is, as I'm hearing, is what drove basically this second fund close. When you were talking to LPs and your own some of these founding offices, what was their expectations around fund performance? Was that really not an issue just because you were so early on from your last raise? Or how did you manage that, or did that question even come up?
Absolutely. I have stacks of paperwork and DDQs and charts and graphs on fund performance. We actually had an exit, a Fund 1 and a Fund 2 exit while we were still raising Fund 2. So we were building our team, raising our fund, et cetera. And our thesis is that we invest post-seed, pre-Series A. We're bridge investors. And so in our Fund 1, we were able to demonstrate how we were getting in at these bridge phases through a number of our portfolio, and how that capital was accelerating them to that next priced round, and then how we were able to double down in that priced round. So not only were we getting great economics of coming in at a bridge phase, if you're going to play in the bridge phase, you got to know what you're doing, because they have to get over the bridge in order for the company to actually make you money on the other side. So we were able to demonstrate that through our Fund 1 portfolio, and that became a clear thesis for us for Fund 2. So while we have a impact overlay to all of our investments, the fundamentals of how we invest are strong and solid, and that's what we led with. And then saying there's an overlooked opportunity to create solutions for low and moderate income communities.
Great. And then what was the sort of size from the strategy around size you went after? We just heard earlier on about First Republic talking about like getting the right size of your next fund. What was your thinking around as you went from Fund 1 to Fund 2 to around size?
Yeah, it was a big jump from a $10 million fund to a $55 million fund. And what First Republic said, I wish I actually had these notes prior to raising Fund 2, but was absolutely correct. Like, we did spend a lot of time with Fund 1, small team. It was me and another full-time person that I was paying half time on a $10 million fund. But our back office infrastructure was really strong. So we have, veteran Silicon Valley fund administrators, tax and audit folks, the best on the legal side. So our infrastructure was strong, and we put other infrastructure, our LP portal. So we, with 10 LPs in Fund 1, we're able to email each LP our LP reports. We have more than that. We have over 60 LPs in Fund 2. Having an LP portal is important. So we spent a lot of time making sure we were shoring up our infrastructure so that when the larger institutions, UBS Bank and Cambridge Associates and others who moved money into Fund 2 were confident that we could actually manage a fund that was five and a half times bigger than our Fund 1.
Interesting. And Bridget, now giving your game perspective from the LP side. So when people come to you looking to raise their second fund, what do you think is often challenging there when you look at them? What do you first consider, and what advice would you be giving to someone as they think to present to you they should lead with? How do you recommend someone when they first start initiating discussions with you should present?
Yeah, I think it's, and as C mentioned, like by the time you're raising fund 2, maybe it's 2 or 3 years after you raise fund 1. So there's maybe not as much traction in the portfolio in terms of just markups. So it's important to lead with the successes in the portfolio that maybe don't show up, you know, just based on the listing of companies and what they're valued at now. So it's important to have case studies to walk through how the companies continue to perform well, in what ways you're involved, and how that you did what you said you would do with fund 1. So that was something that was in the LP survey from Hannah, that, you know, strategy drift in a fund 1, it makes it harder to understand exactly what the plan is for fund 2. And sometimes, you know, there's a great deal at a series E or seed fund, but you have this great opportunity at a series E and it's going to be great for returns, but just having something that doesn't match what you set out to do can sometimes cause some, you know, at least warrant more discussion around with LPs.
And how important is it to have like investors, co-investors of reputable funds in lieu of performance, as to suggest that you got in these great deals with other people? Do you look at that as a proxy sometimes for performance, or are you just that's expected? That's almost like, you know, table stakes that you can get into these deals.
Yeah, I think that's definitely, you know, being able to show that you're getting access to good deals, that you have strong co-investors either investing alongside you or following on you to your round. I think there's a lot of different ways you can triangulate success in a portfolio before markups are necessarily there. And that's one important way.
And what is the pattern? I always think that investing in startups is pattern matching. Would you also say that there's a degree of pattern matching as well in your job, Bridget? I mean, what's as you come better, do you have an intrinsic sense? So I see these patterns. This is a great fund here, or is it more fundamental driven?
Well, I think there are obviously parallels from a founder to a VC and a VC to an LP. And pattern matching exists, but there are obviously problems with pattern matching given the way things have been done, and especially around in backing diverse GPs that haven't necessarily been at the table before. So pattern matching can be you know, a good way to get started, but can make you miss things as well if you're just relying on old patterns.
Right. Okay. Good. So let's a third question, and after the question, then we're going to go to the poll. So I suppose this is some of the challenge when folks are out there is, how do you start networking with the institutional investor? So, you know, you may have had some great contacts, people, friends and family who've helped you fund 1. Now you're looking at fund 2, and we saw from that First Republic graph that sort of slow rise in institutional. How do you engage with institutionals? How does someone who you've never met before, you recommend, Bridget, get in touch with you? What in these times as well, when they can't meet you by chance at a conference, what do you recommend as a way to them to build that relationship?
Yeah, I think that warm intros are always a really good way to get connected to institutional LPs. And I would say do that before your fundraising. When your first meeting is an ask with a fund 2, it's a harder conversation versus getting connected when you're at fund 1, building a rapport with the team and getting comfort around the strategy and all the stuff that comes along with it. So earlier the better, and then relying on your counterparts at other VC firms who have institutional LPs. Find out if there are other LPs that are investing in strategies that are similar to your own, and, you know, trying to get as many warm intros as possible. That's generally a good way to get started. Great.
Keisha, do you any perspectives from your side as you went out there looking to add institutional funding? Do you have any insights?
Yeah, I mean, I think what Bridget said, it's really, you know, if it's location for like a brick and mortar business, it's relationships for fundraising, and really looking at your orbit of relationships. So most of our institutional LPs during their diligence process, they asked for a reference list of founders, co-investors, advisors, and others sort of in the industry that could speak to your performance and your character and your ability to perform. And so, you know, my relationships honestly came in handy. I have some mentors that are tier A VCs in the Valley. And one particularly manages billions and billions of dollars, and that firm's on the Cambridge Associates platform. So it certainly didn't hurt when I put his name on my reference list. And for him to speak to, and we're co-investors, for him to speak to not only them being co-invested in one of our companies, but also we've had one-on-one time. He could speak to my character. He could speak to my commitment to the mission. He could speak to watching my growth and development. So really it's those relationships. And then for founders, you know, as he was saying before, in terms of value add, if your founders can't speak to your value add, you know, that's not good. So, you know, you always have one or two founders in your portfolio that you're not going to have the best relationship, but overall, the majority of your founders have called and asked for a reference from an LP, which they do at the institutional phase, should be able to speak, you know, with nuance to the value add that you brought to their company. So those relationships, you know, don't take anyone for granted. The space is small. People talk, they call each other. There's back channeling. There's a lot of conversations had before an institution moves money into your fund.
Yeah, that's a very good point. References are a very key part of diligence, and it's a 10 to 15 year relationship that you're building with someone in a short period of time. So those references can really add a lot of color and background.
And then how do you sustain engagement? I know one way that you could, was talked about again with First Product, we're talking about building a presence in the marketplace, having content. That would seem to be also a great way to engage. Keisha, are you finding that is it be an effective way for people who you don't know personally to start that relationship and build the brand? Is that something that you've been able to do, and how has that helped? Have you had any over the transom interest from an LP due to some outbound content?
We haven't done as much of that, honestly. We're actually working on our digital strategy and brand presence like right now. We're a small team of 6, so we don't have the internal capacity. Like our core is about making investments, but we do recognize that's becoming more and more important as the landscape. Thankfully, there are more and more funds that are popping up. But we were lucky in that we started out with a very core group of LPs that were impact oriented, family offices, foundations, and their networks. I mean, these are, you know, multi-billion-dollar foundations. They can pick up the phone, they can call their friends. I think someone mentioned that before. So we started out with a really strong core, and that ripple effect, you know, built on itself. But now as we go forward, we're recognizing, you know, there's a piece, or we're mentioning in an article, we do get inbound now requests from investors, which is nice. So it feels like the tables are turning a little bit, but we haven't been as proactive of trying to sort of stage that out. But certainly, I'm assuming it doesn't hurt to do that.
Now, Essie, how about your experience? I'd be interested to understand from you know, what advice you would give to people, how they build those institutional relationships.
Yeah, for sure. You know, what we see is that our LPs, and particularly the institutions, are really grateful when we're transparent with them. And I think the experience they get from the more traditional, you know, older funds is one of great opacity, right? Like a really, really closed door. And so when we're, you know, transparent, we're inviting them to workshops, we're inviting them to join our partner meeting, we're sharing our audited financials, we're giving them quarterly newsletters where we're very authentic. They are really, really grateful for this relationship. And for us, that's been one of the biggest drivers of building really constructive relationships.
And then what was the, any particular institutional investor you want to tell a story around how you engage with them when you didn't know them beforehand? If you have a story to tell, people always helps bring it home if you have someone you started with afresh.
Yeah, for sure. I think to Bridget and Keisha's point, we started building our relationships with institutional LPs in Fund 1. And I will say almost every single relationship starts with a no, because it's like fundraising for the previous fund, like, hey, let's get to know each other, right? Which is perfectly fair, because we also want to get to know our LPs and understand, their ethics, understand their commitment, understand how we make them successful, right? They're our customers at the end of the day, and long-term customers. So it really starts with like getting to know somebody is almost like, how do you get to know? And then from there, start building a more authentic relationship. So we, what we've done for, in cases like this, we've added these very specific LPs we want to build a relationship with to our quarterly newsletter, even though they're not, LPs, they get the same reporting our LPs get. We invite them to some of our events. It's actually easier now because these events are online. Back when we could travel, we visit them periodically. It's really just a slow cultivation. And I think Bridget mentioned that, like setting a goal and then reaching the goal. And the goal doesn't honestly have to be crazy ambitious or unreasonable. It's just a matter of showing that we're reliable and we have predictability in our operations, in the way we execute, the way we scale. So it could be something as simple as, hey, this quarter we're setting up our back office with like an online, investor portal. Wow, that's really an accomplishment, right? We're scaling the firm and continuing to have these milestones.
Great. Well, I think maybe we now can move on to the poll results. So can we have a look at the poll results? There we are. Excellent. All right, fantastic. So we're looking at with everyone here, real time. So what stage are you in raising your second fund? Well, look, so most people haven't started the pitch yet. And there were quite a few of them are actually closing my second fund. That's great. I trust that some of these insights here will be very relevant for you. Next up, what do you think is your biggest competitive advantage? Interesting. Unique fund approach. What do you think about that, Bridget? I'm surprised that that is so high. I would think there would be something along the fulfilled investment thesis, because that was what some folks talked about. But is the second one there? But why do you think that there's that built unique fund approach? Are there a lot of unique funds out there?
Well, I think that in order to raise a fund one, you probably need a unique fund approach. So you definitely would need to continue to have a similar approach probably for fund two. So differentiation is very important, so that at the end of the day, as an LP, you're not the largest shareholder in a company because all of your managers at the VC level are investing in the same company. It's like you need to have diversification. That's, a very important element of being an institutional LP. So differentiation is important, but I think, following your investment thesis for fund one, pacing, check sizes, ownership, co-investors, stage, all that stuff is really important for institutional LPs.
That's good. That's a good insight there. Now let's move on to the next one here. What do you think is your biggest challenge? Okay. Let's see, what do you think about that? Do you think that is that looking at these other options? Is that what you would have put as an answer to if you'd answer this question?
So the biggest answer, the poll result disappeared, and now I just found the button to bring them back up. So deliver. Yeah, I mean that's not to be that's not surprising. It depends, how frequently you go to market. We raised our first fund in 2017, and then our second fund was 2020. So 3-year cycle. It's sort of what we expect to see for each of our funds. It's really a short time to be able to show returns in venture. So we were very fortunate because we actually had some returns. But most funds, when they invest at the seed stage or so, they have to wait like 7 and more 10 years to show some returns, right? So I'm not surprised by the answer. It could change if you go to market a little bit less frequently. Keisha, it sounded from what you said that you had maybe 4 or 5 years from first to second fund. So that may change. The big surprise, I will say, is a lot of people seem to say, I don't have personal relationship with LPs and I don't have a unique fund approach. Because to me, these are like, when you're saying like, that's my biggest challenge, it's like, hey, I don't have customers, right? In other words, in startup speak, I don't have product market fit, or I don't have a differentiated product, which is the same thing. I don't have product market fit. Then it's almost like, well, then you need to pivot, right? If I had invested in a startup that's showing this to me, I don't have enough customers, or I don't have a good value proposition, then I would tell them something needs to change. And so it's maybe a way to say that the challenge is there are a lot of small funds out there trying to raise a lot of money, and so there needs to be some differentiation built into your fundraising approach.
And do you think there's a degree of hesitancy? There you are, you're second year, third year in, you're thinking, should I go to market? Have I made sufficient returns to go out and raise a fund right now? Am I going to spin my wheels for the next 19 months because I haven't got sufficient returns? Do you think, Keisha, that's something that people go through people's heads, or do you think people who are having that should say, let's not worry about the return. We're not going to get them. Let's just go and deliver on our thesis and go out and raise a fund right now after that 3-year cycle. What's your thoughts on waiting to get some form of returns, or just getting into a cadence of a cycle?
Artie, did you want to jump in first?
Sure,
No?
I can.
Oh, okay. I felt like you had something burning to say. I think between Fund 1 and Fund 2, we waited longer than I wish we would have to raise a Fund 2, but I had my mom had a heart transplant, so there was a personal health crisis, and she's doing great, thank God. But that was like, good. Okay, my focus is we're going to manage this Fund 1, but I got to get home and help my family. And so we were a little bit delayed. I wouldn't advise folks to wait as long as we did between raising our first and second fund. For Fund 3, we'll be back out in the market, by mid next year. And we closed Fund 2 last August. So we want to get on that cycle. If you're really trying to build out a platform and manage multiple funds, and this is your business, this is what you want to do, and you're hiring people and you have budgets, you have to keep your business going. And so to keep your business going, honestly, especially a small, boutique firms managing smaller funds, you have to raise additional funds in order for that for it to make sense at some point. So we'll be back out in the market, within the next 12 months to raise a Fund 3. And so I recommend, if you can, if this is your business and this is what you plan to do for at least another 15 years, that you get on a good cycle of fundraising.
Essie, do you have any thoughts you want to share there?
Yeah, I mean, I would definitely add, just like when you talk to your startups, you tell them you want to sell all the time, right? Find new customers and, hone in on your go-to-market and go from selling to small accounts to selling to larger accounts, then selling to enterprise account. You want to have the same thing as a fund manager. So who are my next customers? What value proposition do I need to refine and hone to attract, bigger, more stable customers? It's just like building any kind of business. I will say that it's hard to get, more institutional customers when you don't have the proof point. So to Keisha's point, right, if you're going to market just for the sake of going to market, you don't really have, case studies, results, outcomes, then it's like, well, what are you selling to me? And so getting into a cadence really means consistently and continuously building your firm so that you can show that, yes, I'm actually able now to get a, quote unquote enterprise customer, as in an institutional LP.
Yeah, and I want to just double click on SC calling the LPs customers, because we emphasize that at our firm. It's very important. I think, it's easy to get caught up in the kind of the glamour and the glitz of being a fund manager, but managing a fund is a business and you need customers, you need LPs in order to stay in business. You need to be able to serve those LPs well, right? And the level of reporting goes up when you have institutional investors. And so everything gets, more challenging in the best of ways, but your business is growing and there's more work to do. And so I think thinking about, and I'm so glad that you said that, thinking about the LP as a customer and what do you need to do to retain and grow your customer base is a great way to think about it.
And Bridget, how many times have you made a decision on making an investment based upon the customer service that you've got, the support and the back office capabilities? Is that, how important is that in terms of your decision? If you were, maybe you don't invest in the first series of funds, but a subsequent series, how important is that back office and direct relationship and support in your decision making?
I think in terms of just the back office, making sure that, the wheels are churning and in a responsible way, that's important. I don't think you'd necessarily make an investment decision based off of that, but it shows that you're investing in your business, to use this analogy, and that I think engaging with your LPs just show because you're proud of what you're building and you're passionate about it, and they backed you, so they're probably just as excited about what you're doing too. So it's, everyone can cheer at the end of the day when something good happens, and so communicating that in a timely and transparent manner goes a long way.
Okay, good. So I want to make sure we have some time.
I will add,
okay.
if I can add something. A lot of the companies we invest in are SaaS businesses, right? So subscription businesses, which the idea of a SaaS business is I'm going to get, like some of the SaaS experts call it, I'm going to get a forever customer, right? They're going to renew over and over and over again. And when you think about relationships with LPs, right? Bridget, you said it's like a 10 to 15-year relationship. So it's sort of a forever relationship.
Yeah.
And so the way we think about it is the secret to maintaining those relationships is just like in SaaS businesses looking for, the forever customer. They stay with you forever when you keep in the customer support or customer success, right? If you keep adding value over time, over and over and over again.
Good. Thank you. So I think maybe we'll skip over the last two questions and make sure we have time for more Q&A at the end. So the last answers obviously was family offices, where most people thought they'd get their capital from, and it seems to be in general people are looking at between a 20 to 100 million as their investment size and looking to raise. So let's go and answer some of the questions here. So I'm going to get into is it the Q&A I should go into? Is that probably the right one? Okay, let's try this. So question here, from an LP's perspective, there's one for you, Bridget. What IRR, what threshold, or what type of what type of return, what type of metric would you pay attention to as you're looking at a fund? What are them, if you would like, rank them in terms of the most important metric?
Well, they're obviously all important. DPI is a great one to actually be distributing capital. And I think venture versus buyout tends to be more TVPI just because it's longer holds, especially for early stage versus focusing on IRR. So probably TVPI, but at the end of the day, it's DPI.
Okay, good. Another question here is that someone who is looking to source smaller checks, maybe multiple small checks, and having a hard time getting traction, maybe because of that, with the large institutional funds. How do they engage with family offices? Maybe this is a great one for you, Keisha, because you spent obviously a great success in doing that. How did you find the family offices that you were engaging with, and what advice would you give other people who wanted to go and tap into the family office network?
Yeah, my story is unique, like most people's are, and so first you got to look at your own hand and play it really well. So I actually met my first kind of partner, investor, and now good friend while I was a MBA at Columbia Business School. So I met a man by the name of Josh Melman, whose family endowed the Melman School of Public Health at Columbia. And Josh has been an angel investor, for 30 some odd years, and specifically an angel investor that's been focused on mission-driven investments. And so you can imagine if your family endowed the Melmo School of Public Health, you're in a certain network. And we were able to collaborate and work together for 3 years with moving money in a sustainable, responsible way on his behalf, as well as the behalf of a very large, a female, she remains anonymous, but one of our world's billionaires, a good friend of his. So we were able to work off balance sheet. And I was able to build kind of a demonstration portfolio prior to launching Impact America Fund with that family office. So I did that for 3 years. And then with the support, when I decided I was going out on my own to build my own platform. Thankfully, I had done a good job, and they were one of my main anchor investors. So that, I kind of, quote unquote, met the person who opened up a door and a world to me that I think would have been very difficult to get to otherwise. And then family office, no family offices in the community of ultra high net worth people. There's spaces and places and networks and communities that they're a part of. And that's how I built my relationships and trust, to be honest. Family offices are looking to back people that they know and they can trust, or that someone knows them. So it's a very highly networked area. But if you can get in and build relationships with one or two, then that starts the kind of ripple effect there.
And Essie, did you start off with family offices? What was your first amount of capital in, and did those family offices invest this for your second fund, or is it first and done?
So most of our Fund 1 LPs followed on into Fund 2, which was really important to us. And not only did they follow on, but they often increased their commitments and referred other people. And to us, Bridget was talking about what are the signals that she's looking for. A lot of our investors, that's the kind of signals they look for. It's like DPI being the best one, because like, are you returning? Are you really having a flywheel going? But as you go initiate that flywheel, if your customers are following on with you, it means that they actually see a path to that flywheel. So that upsell rate is actually really, really important. And then to Keisha's point, what is going to compel these high net worth individuals, these family offices, to trust you in the first place is do you understand what they want to do, right? It's really honestly a lot less about you than it is about them and what they want to accomplish and the impact they want to make with their money, right? Do we fit in some of one of their goals, dreams, objectives, and some of them are financial goals, and some of them are very different, like goal of making an impact, goal of changing the world a certain way, goal of learning something, goal of having access to something they can't touch. It's really it's a sales job, understanding what people want.
Well, good. And then I have another question here, maybe to you, Keisha. Is that what technology are you using? When you go out there, are you using Google Sheets, or you got something more fancy than Google Sheets to manage your flow?
As for fundraising?
Yeah.
Yeah, no, I have a fantastic ops woman that I brought on to raise Fund 2 because I needed help and support. Fundraising is its own full-time job while we're building the team and the operations. And so we have tools and systems. We've been a remote team prior to COVID, so we are set up systemically to work as a remote team and bells and whistles. I have a systems engineer on my team, a PhD, a computer scientist. So our systems are probably more sophisticated than they may need to be. And so she created, I'm trying to think what were we using initially, but she had found it was some tool we were using to track fundraising meetings. And I was like, I'm like old school. I have my notebook, I have notes and my Excel spreadsheet. But going forward now, our list is growing, and we obviously need more sophisticated management. I was just introduced, someone told me about a tool, I have not used it, but a tool called Omni that's out there, AUMNI, that's supposed to be really helpful for this. But I deferred. I was an investment banking analyst, so my skills are in Excel still, so I defer to that.
And then do you have a as a way to connect directly into your LPs? Do you have what tools you use to measure them? Do you use like a SendGrid or MailChimp, or what tools do you use for all that stuff? Just help people understand what's made you successful.
Yeah, it's interesting enough, you asked about kind of brand building, and we toggle between getting a wider audience and people, for people to know us. But at the end of the day, what Essie said is, yes, we need to reach our founders, and we want a certain type of founder at a certain stage, and we make certain investments, so we want to attract those founders. But from a fundraising standpoint, in terms of brand building, we have a very special community of LPs, and where we're at now is like, how do we work the community that we have? Like, how do we get them more engaged? And so we use, our newsletter. We have 3,000 people on our newsletter, but this newsletter is like the best of the best and the who's of the who on this newsletter. And so we're not sending out newsletters every day because our people are busy, but when we send out a newsletter, we get huge open rates. We use MailChimp for that. We've been doing that for years now. We had, for the first time for Fund 2, we had our first LP meeting. For Fund 1, we were so small that we didn't convene our 10 LPs. We can meet them one-on-one. For Fund 2, we had our digital LP meeting in November after the election, or right before the election. I'm trying to think. It was right before the election, because there was some conversation about the election. And we used the tools of Zoom and Hopin and what have you to have a pretty fantastic digital LP meeting. And we have 100 attendees, and that's like, amazing to think about digitally. How do you engage 100 attendees? And we had workshop sessions. And so what we realized from that LP meeting about our LPs, and everybody's LP base will be different based on who you're raising money from, but they like to be engaged, is what Esty said. Like, do you know your customer? They want to be engaged. Like, we know which LPs care about financial inclusion and fintech. We know which LPs care about health and well-being and innovations in mental health. And so now we're workshopping these LPs with our portfolio founders. What we've learned, the closer you can get the LPs to the action, because they're removed from the action, the more they lean in, the more involved they are. And honestly, like, they will think of resources and pull on resources and levers that you don't know they have unless you ask. Like, they're not going to offer it up necessarily because they're managing, I'm sure, Bridget, a large portfolio of a ton of funds. But if fund managers actually ask and put the LPs in position to know more and to lean in, they're very excited to do that. So our strategy, everybody's strategy, you have to look at your own hand, but our strategy is to continue to deepen the relationships that we have with our LPs. And then the tools, you use whatever tools, but think about what the strategy is first.
I think this is a great way to finish off. We've got to top of our hour here, getting close to the action. I think the 80 odd people who've been on this call, not quite 100 as in yours, Keisha, but the 80 odd people here have got some great action, learned a lot. And so I'm really grateful for everyone who's put some time aside on this panel. Fantastic work, everyone. Some great insights. So I think we should probably close it out. So thank you, All Raise, for making this happen. Thank you, First Republic, for being a sponsor. And everyone, and have a great holiday long weekend. All right, everyone. Thank you.
Yes, thank you.
Thanks, Ian.
Everyone, take care.
Bye.
Bye.